Good morning from London. I'm Anna Edwards alongside Guy Johnson. We're an hour away from the opening trade. Here's what you need to know. A decisive move. The Fed cuts by 50 basis points in a bid to support the US labour market. But Chair J. Powell cautions on the speed of further easing. The Bank of England. Up next, economists expect UK rates to stay on hold. But will Governor Andrew Bailey give any hints about a reduction in November? And Lebanon is hit with a second wave of exploding electronic devices. Israel declares a new phase in the war and says troops will be diverted north to the Lebanese border.
Let's take a moment to think about the price action and to understand it. If you're sitting down at your desk this morning, you're lighting up your Bloomberg terminal, you're trying to figure out where we go next, I think it's worth spending a moment just figuring out what is going on. This was the session yesterday, the S&P. Back end of it is where we need to focus our attention. The Fed comes out, it cuts rates by 50 basis points. We see the stocks initially going higher, but then we get a fade into the close. The real question is, between the press conference ending and the end of the session, is there enough time really to take a useful price signal in terms of the price action that we got yesterday? Now, if you take a look at today's session, let's talk about Asia first of all. Maybe you actually get a much more positive reaction to the story. As you can see, lots of green on the screen here. The topics in Asia, Asian markets overnight, very strong. You've got S&P futures up by 1%. You've got Euro Stoxx futures up by 0.9%. You've got a more positive picture on the yield story as well. Is this the better reaction, the cleaner reaction, the truer reaction to the price action we saw immediately after in the United States? That Powell press conference. That's, I think, what we need to debate this morning. The countdown to the opening trade here in Europe starts right now.
I do not think that anyone should look at this and say, oh, this is the new pace. You have to think about it in terms of the base case. Of course, what happens will happen.
What did we take away from yesterday? What happened yesterday? Was it exactly what we thought was going to happen? We were certainly guided towards a 50 basis point cut from the Fed. That was what got delivered. The price action following it, I think, Anna, is something that we need to spend some time thinking about. Powell has delivered 50 and then basically pulled back. And I'm wondering kind of what the message is in all of this, how we should think about why he delivered 50 and what the subsequent message is about where rates go from here. Yeah,
was he trying to add something, if not hawkish, just not too dovish, to the pretty dovish decision to cut by 50 basis points in terms of messaging? I mean, it is difficult to land a message that is, at its heart, the economy needs a cut of half a percent, but the economy isn't doing too badly. And the fact that those things are difficult to sell at the same time means I think we're justified to see strange market reaction and different, disjointed market reaction in different asset classes. I mean, oil prices, for example, yes, they're up a little bit this morning, but they seemed, for the last 24 hours, all just too gloomy to sort of join in with any kind of risk rally. So even in the initial aftermath, where we saw stocks rallying, and you pointed this out, we did see that stateside. It wasn't across all sectors, and as time settled in, certain investors started to question, what exactly had been delivered here.
Yeah, you look at what happened, for instance, in the Russell 2000. Big fade into the close yesterday. You would have thought in some ways that actually what you would see here is a broadening out. What you would see here is small cyclical stocks that are geared to the economy, maybe seeing a pickup, actually improving. That didn't happen. The mid-caps may be a slightly different picture, but that wasn't the narrative. The expected narrative wasn't the one that we ultimately got. Now, Mark Cudmore talked about the slightly sort of counterintuitive response that we should expect, and we definitely got a counterintuitive response. Is today the cleaner read? I don't know. Is Asia the better read on what is happening here? Or have Asian traders got a better handle on what the picture really looks like? Because we didn't see enough time, maybe, between the end of the Powell press conference and the close to really kind of figure out what was happening. Yeah,
it does seem as if Asian markets and into the European session, if futures are to be believed, we're just maybe taking things more at face value. But to your point, is it just a sort of cleaner picture? I mean, maybe something in what happened with the dollar has something to do with this, because we saw maybe it was unwinding of shorts in the dollar that we were witnessing yesterday that's pushed the dollar a little bit stronger, because you might have thought going into it, well, this is going to be a sell the dollar moment, because if they're cutting by 50, that's going to put interest rate differentials back on the table, and we continue to see weakness in the dollar. But maybe the dollar move had been overdone into the press conference, and that often filters through into other asset classes.
Let's talk about the Bank of England. While the Fed has moved from thinking about the inflation risk to thinking about the labour market risk. The Bank of England can't make that journey, it feels like, yet. It still has this risk of the underlying inflation story within the UK economy to worry about. And that maybe puts it in a very different position to what we saw yesterday out of Powell.
Yes, very interesting. Yes, so a little bit more lingering on the inflation dynamics rather than moving on sort of nicely, neatly onto a labour market story. But then at the same time, we do have some economic weakness to talk about. The last couple of months of just the monthly data on GDP has not been pretty. I was looking at some comments from Templeton yesterday saying if there wasn't a budget coming up, they would have cut again. They would be cutting again. But it is that sense that we have to wait for some clarity on the fiscal. Even if what we sense in the fiscal story is there's going to be higher taxes and that maybe that means we're going to see bigger interest rate cuts. Perhaps in the near term it means a pause and a wait and see what they get given on the fiscal front.
But is the Bank of England going to focus on growth? Is the Bank of England going to be more concerned about what is that lingering inflation story that remains in the UK economy, probably more so maybe than anywhere else, you could argue, in terms of the majors right now? It does still have a labour market issue that is pointing it to tightness. It does still have a service-side economy that is still experiencing quite significant amounts of inflation. Can it, at this point, with a clear conscience, say, you know what, we think we can put inflation in the rearview mirror in the way that the Fed has? Yes,
and we saw some of that nervousness around the services side of the inflation story just yesterday, didn't we, in that data. On the other sort of agenda items to watch when it comes to the Bank of England, there's going to be a focus, and we talked about the fiscal a few times this week, there's going to be a focus on gilts and what the Bank of England decides to do with its balance sheet. Does it stick to the existing pace at which it sells? This is interesting and links to the fiscal because the lower the amount of gilts they sell, and remember they sell these at a loss for the Treasury because of the way that they are accounted for by the Treasury, the more room that Reeves would have to move on the budget. Now, whether she wants to change the way she accounts would be an interesting political question and perhaps not one for today. But that is something we're going to be looking for guidance from the Bank of England on.
Can I just fold Next in? Next results are just hitting the tape at the moment. What Next has done is boosted its full-year profit forecast. Now, the numbers look kind of in line to slightly soft, but depending on which line you want to look at. But what it has said is it sees now full-price sales plus 4%. It saw 3.4%. Next is raising its full-year profit forecast. Does that imply that the UK consumer is still in OK shape? Does that imply that the UK consumer needs more rate cuts? I wonder. This is a pretty good barometer normally on what is happening on the high street. Yeah, and if one company isn't enough, we've got Ocado raising their revenue guidance for Ocado retail today. So we'll keep an eye on those sort of micro indicators on the UK and how they add up into the macro. Let's divert our attention, though, to the Middle East, Guy, and to what's been going on there. The fears of wider conflict in the region growing, I suppose. And we've seen day 2 of violence, exploding mobile and other devices over in Lebanon. 26 dead over 2 days. So this is 2 days of these kinds of attacks. And Israel, the Israel Defence Minister, talking about a new phase of the war and suggesting that troops will be moved further north to the Lebanese border, an area where we've seen plenty of violence on both sides and disruption. We were trying to ask the question yesterday whether or not these attacks were designed to de-escalate the situation. It appears maybe that maybe isn't the case. Maybe this, speaking to the troop movement, is a case of maybe a preemptive strike designed to take out the leadership of Hezbollah before the attack happens. And it is a precursor, therefore, to this wider conflict, which everybody has feared. Yes, everybody feared, including the United States, and that must be a priority for the US administration, is to not see any widening of that conflict. I mean, Lebanon and the Lebanese government and Hezbollah have both blamed Israel. Israel, of course, has not taken responsibility for it. But we've seen on both sides of that border, thousands have already fled their homes and many have been killed. So if we do see further violence there, that will no doubt focus the minds of international players. And we have foreign ministers meeting with Anthony Blinken, foreign ministers from across Europe meeting with Anthony Blinken today to talk about, no doubt, this and also Ukraine as we approach the US election. And you've got to think about this as well through the prism of the migration story, which is affecting so much at the moment in Europe. Is this, again, part of that? Will it force people out of the region? Is it something that we see in a similar way that we saw in Syria, maybe affecting Lebanon? We all remember what happened in the 1980s. Let's talk about what we've got coming up in the show. Jens Larsen joins us from the Eurasia Group. His thoughts on what we saw last night from the Fed. Hannah Bernard from Barclays, co-CEO of the Invest in the Women Task Force, joining us a little bit later. We're going to talk about her programme, and we're going to talk about her assessment of the Labour government as well in terms of what it is signalling about investment in the UK. We're going to talk markets with Kim Crawford of JPMorgan Asset Management and John Bell of Newton Investment Management a little later on the programme, Anna. It's a busy day. We're trying to digest what we got from the Fed. Did the market really get what it wanted yesterday? Maybe not. Certainly with the longer-term story, that appears to be the assessment of a lot of people today.
Yes, absolutely. Let's move on to some of the other data points we're going to get out today and just put those on your radar, and some of the rate decisions, because we're done with the Fed, of course, but plenty of other rate decisions to come. We've mentioned the Bank of England. We also get the Norwegian rate decision coming. That's actually right after this programme, so in less than 2 hours' time now. Then we get the Bank of England, we get South Africa, Turkey, rate decisions coming thick and fast through today. We get some data over in the United States, the usual initial jobless claims, it being Thursday, and some other data, and we get some ECB speakers. But then we also get, Guy, and this I've just lingered on for a moment, the FedEx earnings. We're watching again for any weakness in the US consumer story here, or the global consumer, but in particular the US. Any price sensitivity as well seems to be in focus as we head towards, I can't believe I'm saying this already, but head towards, you know, the end of the year, the holiday shopping season. What does that kind of look like? And any cost savings that they can do to sort of mitigate any negativity around the consumer.
We're all trying to understand what is happening with this US economy. Is the consumer slowing down? What is happening with the consumer? Is this something that the Fed needs to be reacting more aggressively to from here? The signal last night from Powell is probably no. But we're all on tenterhooks waiting to see what the data tells us, and the FedEx numbers are a kind of real-time indicator as to what is going on there. Yeah,
really interesting indicator on the global economy, often looked at all kinds of areas of the logistics space, often looked at as some kind of canary, and with China being as weak as it is, and with Europe struggling, we'll talk more about that in a moment, that certainly could be in focus.
What else do we need to know this morning? Let's figure that bit out. HSBC is cutting its key benchmark rate in Hong Kong. This is the first time it's done this since 2019. The move is expected to hit margins, adding pressure to a bank that is already looking to cut expenses. Talking to the financial sector, Commerzbank is looking to speed up the process of replacing its CEO amid a possible takeover by rival UniCredit. Bloomberg understands that CFO Bettina Orlop is still viewed as a strong candidate to succeed Knopf, who is currently the CEO. The bank will vet external candidates, we understand. Commerzbank at this point declining to comment. And car sales in Europe dropping more than 16% in August compared to a year ago. Germany led the drop as demand for electric vehicles has absolutely cratered. EV deliveries in the region's biggest market plunging 69% during August to just over 27,000 vehicles. The wider European story is problematic at the moment. The car story is at the heart of that. But you think about kind of where the Fed is and where Europe is right now, it feels like a really different problem.
Yeah, it does feel like a different problem. But just to linger on the car story a little bit, EV sales down by 69% year-on-year in the month of August. But a lot of this has to do with tough comparisons. But why are the tough comparisons from last year? Because there was a lot of support around the sale of EV vehicles, in particular in Germany. And that's led through into real weakness in the German numbers coming through this time. And the car sector it just can't catch a break, can it? We've got competition from China. We've got, looking back, of course, the pandemic, the supply chain issues that led to, inflation weighing on people's willingness to buy cars, and all of that adding up to a really tough picture for not just Germany, but for the whole of Europe when it comes to car
Wang
sales.
Rentao, the trade advisor from China, is meeting Dombrovskis today. The message is don't slap huge amounts of tariffs on our car sector, but Europe's car sector is struggling right now. But Europe, I think Europe faces a really difficult question right now. On the one hand, you've got the green agenda. On the one hand, you've got this idea that we want to push further forward and we want to make our targets in terms of net zero. Isn't the fastest way to do that just to import lots of very cheap electric vehicles? But on the other hand, you want to preserve the economic base that exists and have your own capability.
Yes, and it is a very political global economy we live in these days, isn't it? You see with the Inflation Reduction Act the extent to which the US government is prepared to support its own and, to be fair, to support other companies from around the world that want to invest in America. So there is a sense that we live in times where governments are prepared to do more. I would just point out, as well as that decision around tariffs, there are new EU fleet emission rules coming in next year, and a lot of the automakers in Germany pushing back against those as well.
Europe is meant to ban combustion vehicles by 2035. 10 years from now, does it feel like we're on track for that? Absolutely not. So you do wonder whether or not there's going to have to be some thoughts on where the rules need to be changed in order to make that timeline feel a little bit softer. The other kind of story I would take away from this, if you're not going to allow cheap Chinese cars in, your cars are going to be more expensive in Europe. Does that mean that we're going to see... Is this inflationary? Does this come back to this ECB versus Fed story and the narrative around that as well?
Yes, and thinking of central banks and where we go on inflation, we have a focus on the Bank of England, of course, today. Coming up on the programme, we're live outside the Bank of England as investors await a decision and any hints on future cuts, plus the future of EVs. China Commerce Minister meets with the EU over its tariff plans. That meeting takes place today. A lot of lobbying going on within the auto space. We'll talk about all of that. We'll get an update later. Up next, more on what markets are expecting for the rest of the year after the Fed's bold cut. If you have any questions for our guests, then please do get in touch with the team. IB plus BBTV Go is the function to use. This is Bloomberg.
The Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by a half percentage point. A broad set of indicators suggests that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of elevated inflationary pressures. I do not think that anyone should look at this and say, oh, this is the new pace. You have to think about it in terms of the base case. Of course, what happens will happen. If the labor market were to slow unexpectedly, then we have the ability to react to that. We have greater confidence now that inflation is moving down to 2%, but at the same time, our plan is that we will be at 2%.
Fed Chair Jerome Powell launching the unwind of US rates, big initial outsized cut, then a little bit of caution. Jens Larsen, Director of Global Macro Geoeconomics at Eurasia Group, sitting around the table with us this morning. Your thoughts on what we learned yesterday?
Well, I think at the end of it, we didn't learn all that much, and the market doesn't seem to have learned that much. We learned a bit over the last week, didn't we? Going into the last week, I was expecting 25, and then as of last Friday, it shifted to 50. And I think with the approach the Fed has taken here, they're running three risks. The first is that they are unintentionally sending a signal about the U.S. labor market, about the U.S. economy that signals weakness. He countered that strongly, but that, I think, is still the risk. And I think the second is you're creating volatility, shifting expectations the way they did, but also when you're looking at the dot plot, a lot of variation in views on the committee. And then the third one, I think there's a political angle here. They're not taking a political decision. They stress that, and I think that's absolutely true. But every decision you're taking in the run-up to an election is going to be a political one.
How big a risk is Powell running by doing what he's doing now if we were to see a Trump victory in November?
I don't think it's a big risk. It's an accumulation of risk, and let's face it, Trump has been critical of the Fed already, and he's likely to continue to be critical of the Fed. He has stressed that he will be vocal about what the Fed is doing, and I'm expecting him to be vocal in the coming days about the Fed having supported the Democrat side. And the president endorsed the cut yesterday and welcomed that, so there is definitely that political dimension. I think the big issue is that if Trump wins, the policy agenda he's suggesting next year, the combination of fiscal, the combination of labor, of migration, and the tariffs that he is likely to implement, all of that is going to add to inflationary pressure and will put pressure on the Fed. That's the point at which you need the credibility.
I saw a note from one bank this morning, and I wasn't sure how seriously this was intended, but saying that, we saw one dissenter yesterday, and actually the first dissent at the Fed since 2005, which was a nice reminder to me of how rare that situation is. Michelle Bowman voting for a 25 basis point cut. And one bank suggesting this morning maybe that puts her higher up the list of potential successors to Powell if we do see another Trump presidency. I mean, is that the kind of politics we're talking about here as well?
I think there's that kind of politics, personal politics and low-level politics, if you want, and I think it matters. Trump has demonstrated that kind of action and policy will matter. But I think the bigger picture here is one of committee that has sent not a very strong signal, quite a difference of view on the committee. Some of that expressed in the vote, which definitely surprised me. But also, again, when you look at the dot plot, a very wide range of opinions.
And how much do you think politics will be in or outside the mix when it comes to the Bank of England? Because the BOE has to decide how to do quantitative tightening, how to, reduce the size of the balance sheet. And because they're doing that at a loss, that has and then that's accounted for by the Treasury. That has an impact on the fiscal headroom that Rachel Reeves then has. Yes. That's an unfortunate linkage, perhaps, but one that we need to think about?
I think unfortunate linkage is exactly the right expression, which is the bank doesn't really want to make a decision on its balance sheet that has political implications, and the Treasury, the government, shouldn't be taking decisions that are influenced by the bank's essentially operational decision to reduce the size of the balance sheet. So it's an unfortunate link. I hope it doesn't affect the bank's decision. I think they will make the balance sheet decision today as boring as they can, so I think they'll stick to 100. But I think the answer to this is to remove that influence by changing the fiscal rule so that the banks, the losses that are run up on the APF doesn't affect the fiscal position. It shouldn't. That was the plan originally, and it shouldn't do it now.
Sticking with the Bank of England, has the Bank of England made the journey that the Fed has made from worrying about inflation to worrying about the labour market? Should it make that journey? Is it too early to make that decision?
I think the bank is more concerned about persistent inflationary pressures, and I think it's right to be. You look at the numbers from yesterday, and you see the continued domestic inflationary pressures and the relatively tight labour market. So yes, I think they're on the same journey, but I think they're on the journey on a lower speed. I think the market is right about that. In fact, I think the market is pricing too aggressive a Bank of England. There's no cut in pricing for today, but I think the pace they're going to go at is 1.25, reflecting that inflationary pressure. They need to reflect their assessment of the labour market, of inflationary pressures as they go along, and to move the committee along with that, I think they will need to go gradual.
Can we talk more about what is happening in the labour markets? At the moment, we have a migration debate that is taking place globally, certainly in developed markets. You see a situation where if economies are going to grow without too much inflationary pressure, migration is going to be required, but that migration needs to be managed. At the moment, we're dealing with a lot of unmanaged migration, which is making the managed migration much more difficult to kind of persuade people that it's a good idea. What does that tell us about the longer-term outlook for inflation?
I think migration has become an essential component, both in the US and also in Europe, an essential component of generating growth. And managing that, particularly with aging populations, is going to be a huge political challenge. Right? So everyone can see we need to raise labour force participation, we need to strengthen labour input, but it's very hard to see a political solution to the pressures that migration are putting on. I think the most direct risk is in the US, where a Trump administration and a very restrictive migration policies would have an immediate impact on the inflationary outlook. Europe is harder because unmanaged migration or refugees is very much a political issue, very much an issue related to the conflicts. Yes. So much harder to predict. But the overall issue, that of either raising labour force participation or raising productivity growth, as the Draghi reports alludes to, these are the way forward. So
yes, I was going to say, if the alternative to migration and population growth to drive growth is productivity, where has the fiscal space to lean into that?
So I think Europe actually has fiscal space. I think the fiscal issues we are seeing in Germany is almost entirely a function of their own self-imposed rules. There is room in Europe to raise investment. I think it's absolutely critical. The same is true in the UK. I don't think the market would bat an eyelid if the government turns up and says we want to raise borrowing in order to raise investment, because that does generate growth, and ultimately that's what you need. So I think the fiscal space in Europe is there, but is there the political will to create that fiscal space? Is there the political momentum to create some form of strategy for investment, either at the European level or at national level? That's where I see the struggle at the moment. The German government entirely focused on these in the bigger scheme of things, small fiscal problems. You look at the French government, and it doesn't look like it's very much focused on structural reforms on the country. It's focusing on survival, and it's focusing on implementing a budget.
Jens, really nice to see you. Thank you so much for joining us. Jens Larsen, Director of Global Macro Geoeconomics at Eurasia Group, from the Fed to the Bank of England to Europe and the productivity challenges and the political challenges that exist. Lots to cover in that conversation. 7:26 here in London. Coming up on the programme, we'll be hearing from Hannah Burnett, who is the Head of Business Banking at Barclays. We'll talk about the Invest in Women task force. That's now been backed by the UK's Chancellor, both because she says it's the right thing to do, but also she thinks it's a growth opportunity. So we'll continue that growth conversation. This is Bloomberg.
Thursday the 19th, good morning. 30 minutes to go until the start of trading here in Europe. If you're confused by the price action on the screens in front of you, I think you probably have good reason to be. We saw a sell-off in the States yesterday post Powell's press conference. This morning, though, futures are looking much more positive, including those in the United States. Asia has had a very good night, you could argue, from a European point of view, with Japanese markets in particular up quite strongly. Is today's market board, i.e. the futures board that we're looking at right now, a better indicator as to true sentiment of the market post-Powell than the action we saw post the press conference yesterday? I think that's a question that a lot of people are trying to figure out this morning.
Yeah, there seemed to be a lot of complexity in the mix yesterday. The bond market moves, what we saw on the dollar not necessarily being what everybody would have expected the knee-jerk reaction to be. Let's move on to the Bank of England, though, today, because that moves centre stage. The Bank of England is up next. The UK Central Bank is likely to decide against cutting rates for a second straight meeting, maintaining a patient approach to reversing tight policy. Bloomberg UK correspondent Lizzie Burden is out in the field for us outside the Bank of England. Lizzie, good morning. So does the half-point Fed cut last night make it any more likely that the Bank of England cuts rates today? Join some of the dots for us.
Well, Anna, Guy's been teasing me that this BOE event I'm covering today is perhaps the most boring of the central bank decisions this week. But maybe Jay Powell spiced things up a bit with that half-point rate cut, because you could argue that a dovish Fed plus a hawkish BOE equals a stronger pound, equals more expensive exports, means weaker growth, which could persuade the BOE to go for the cut. But you could look at it the other way and see it that Jay Powell's actually done a bit of the work for Andrew Bailey today, and he's managed to thread that needle that there is going to be a soft landing in the US, that messaging meaning perhaps that the markets and the BOE need to fret less. But you also, of course, had the inflation data out of the UK yesterday, a stronger services reading. Yes, it was less than the BOE had forecast. Yes, it was down to volatile inputs, but this is something that the BOE has said it's concerned about. And of course, we heard from Andrew Bailey at Jackson Hole. His message is caution. So the expectation among economists is still that we're going to get no cut today. What you could even see is a less finely balanced split than the last time. So economists expect 7-2. We're looking, interestingly, at Alan Taylor in particular, the new member of the MPC, looking how he's going to vote for the first time.
Yeah, what do we know about him? Is he a hawk? Haskell's a hawk. He replaces Haskell. Is he more dovish than Haskell? One would assume probably yes. So what kind of clues do we know? Because I've been trying to read about this, and I haven't actually found very much in terms of expectations around what Taylor is going to deliver.
It'd be hard to be more hawkish than Jonathan Haskell, put it that way. But then if you look at some of his recent writing, Alan Taylor, you can see that he's worried about being too restrictive on the economy. So it will be interesting. What is expected is that he's going to go with the majority in his first meeting. And this is why we're expecting it to be 7-2 and for him actually to go for the hold.
Lizzie, thanks very much. Bloomberg UK correspondent, of course, Lizzie Burden. Getting all my words mixed up this morning, on the ground for us outside the Bank of England. Well, staying with the UK story, the Chancellor, Rachel Reeves, has endorsed the Invest in Women task force. This follows findings that female-founded businesses received just 1.8% of total equity investment value in the first half of this year. Rachel Reeves, in backing the task force, said we can, quote, establish one of the world's largest dedicated investment funding pools for female-powered businesses, helping grow our economy. We're joined now by the co-chair of the Invest in Women task force and head of business banking at Barclays, Hannah Bernard. Very nice to speak to you once again, Hannah. Thanks for joining us. So we'll get your take on the wider UK economy in a moment, but let's start with the Invest in Women task force and the fact that only 1.8% of the money is going into female-founded businesses. Why is this number so stubbornly low and so difficult to get higher?
Yeah, and you know, because last time I was on here, we talked about the decade that's been the case has been less than, it was actually less, it was 2.5% last year. The latest data it's got even worse, 1.8%. I guess there's a variety of reasons. I would put it down to there's a structural issue that we have. We have a structural pipeline, or what we'd call like a funnel issue, where we've got actually the latest data for the Investing in Women Code report that also comes out today, shows that actually 27% more pitches are coming in from female and mixed teams, but actually they're still failing to get through to the investment stage investment committee. So we have a real issue in diversity of the investment committees. and they are not backing women to the extent they should be.
So if there's a lack of diversity among the people who are deciding where the money goes, where they want to put the money that they're managing, if they can't see the potential in the ideas that are being presented to them, that's why sometimes ideas that come from female-led businesses are held back. Is that the gist of it?
I mean, so like 11% of our investment are made of women, only 11%. 14% of angel investors are women. And I think there's a study that shows that female investors are twice as likely to invest in female founders as their male counterparts. So I think we do have a structural issue, and we do need to urgently address the amount...
Why is that? It can't be that... I mean, they genuinely see opportunities differently.
Yeah, and I think, diverse teams make better decisions. I think people tend to invest in things they know. And I think we've got an opportunity with the task force to create this funding pot to direct money into female investors, thus changing the structure of the investment landscape to the extent we can, and then they will then invest in female businesses.
How does the investment landscape look like? What does it look like right now? Is it positive? Well, I keep talking to investors that are telling me they're slightly concerned that the government is delivering a slightly downbeat message, a very downbeat message, and that is starting to percolate into investment decisions that are being made more broadly.
I mean, I think it is a tough landscape. You talk to entrepreneurs and they are finding it really tough. I think there's a skew towards later stage investment at the moment. I think there's a real paucity, if you like, or sparsity of investment at the lower end. Early stage investment is really, really tough. So we're doing what we can. We need to get the task force to get funding at every level of stage of investment.
Yep.
And we've had some really strong support from financial institutions. We still need a bit more, but we're hoping to announce where we've got to with that fund in the next few weeks. So I'm hoping I'll be invited back to talk to you about that then.
We should look forward to it. Do you think tax hikes deter investment? And if so, what do you worry about in the budget?
I mean, I think it depends on how we are relative to the rest of the world. You know, it's a...
How do you think we are going to be relative to the rest of the world then after the budget?
Let's see. I was at an event last night with the Chancellor.
Yep.
She's very pro-growth, so I'm hopeful that she understands where we are. So, you know, let's hope for that pro-growth agenda when it comes.
Are entrepreneurs nervous that if the Chancellor tries to increase taxes on private equity, carried interest is the thing that's being talked about a lot, has been talked about a lot in that sector, that then entrepreneurs are also in that same bucket and kind of get caught up in that? Is that something that the Chancellor needs to be aware of?
I mean, I spoke to some entrepreneurs on site who have told the government that directly. They are nervous because it's their livelihood, and I totally understand that. But at the same time, we need to do all of our... It's more than just that. There's a broader, you know, environment issue for the funding landscape that also can seek to mitigate that if we can get it done right.
Yeah. Away from the sort of more... I mean... slightly away from maybe the more cutting edge of the entrepreneurial space, what does the UK corporate landscape look like, the people you're talking to, the conversations you're having about the UK economy? Because the growth data over the last couple of months seems to be sort of flatlining a little bit, but we're waiting for a lot of things, waiting for all the, you know, to understand the fiscal landscape a little more.
Yeah. So, well, at Barclays, we look after 1 million small businesses, and generally sentiment's been growing as we've gone through the year. I think the stability of the political environment, the rate environment, inflation becoming more settled, I think that's all starting to allow people to get back to looking forward, to looking to growth. And we've had, you know, we're open for lending. We're having lots of conversations to help them invest in their businesses. I think there's a nervousness about the budget. You know, there's things like workers' rights that they're not sure about. So we'll wait and see how that pans out. But I think so far, actually, things are starting to stabilise and people are starting to look forward and build.
So is your sense that demand... Is there a certain amount of sort of pent-up demand for borrowing that is going to kind of open up after we see the budget? Once there's clarity after the budget, would you expect demand for money to increase as a result of the clarity that is going to come from that budget? Or do you think the budget is going to be onerous on small business owners and therefore actually that won't happen?
I think we'll need to see. I think there's been steady demand, actually. It's not like there's been a lack of demand this year. I think it's been steadily...
So it's not an air pocket that exists before the budget?
I think there's going to be continued demand as we go through, subject to whatever lands at the budget.
If the operating environment for small businesses gets tougher as a result of the budget, is that, just to come back to the beginning of the conversation, is that then amplified back into the availability of funding for women-only businesses? If the overall environment gets tougher, does the operating environment for women-only businesses get even tougher because of what is happening at the core?
I think that's exactly right. I think it's because people then go for safety and security, and I think there's male investors, whether we like it or not, will go for the later stage, the more established track records, and it will start to just...
So that latter stage move is basically everybody kind of seeking cover at the moment.
I think so. Yeah.
Hannah, thanks very much. Thanks for joining us. Hannah Bernard, co-chair of the Invest in Women Task Force and head of business banking over at Barclays. Nice to get her perspective on the programme. Coming up, we will stick with some UK names and how their stocks could be on the move this morning. Ocado delivers a sales beat. More on the online grocer's latest results. That's coming up. We'll get a rundown of that and other stocks to watch shortly. Stay with us. This is Bloomberg.
I'm David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Welcome back to the programme. 7:44 here in London. The futures picture looks buoyant. The trading in Asia looks buoyant. US futures look buoyant. Let's talk to our Markets Live executive editor, Mark Cudmore, about the markets in 3 minutes. Mark, let's start with that buoyancy in risk assets. Yes, the Asia session looks good. European futures look higher. US futures also higher. Yesterday's equity market picture was a little more confused. How much of a bull market are we looking at here?
We're in a proper bull market, and what I mean by that is that we shouldn't get too bothered by the short-term moves. We're going to have more fluctuations in the week ahead. We might sell off tomorrow. It does not mean that we're not in a bull market. The reason that we're in a structural bull market is that we have the most important central bank in the world pumping another injection of animal spirits, of stimulus into the arm of an economy that is doing absolutely fine. Atlanta Fed GDP now just ticked up to 3%. Growth in the US is likely to be this year as good as last year, if not better. Growth this quarter in the US is likely to be better than last quarter. Growth this year globally is likely to be better than last year. I don't know where this slowdown is. There are certain sectors, if you look for them, sure, hiring slowing down from a crazy level, retail sales are slowing down from a crazy level, but overall growth is good, and yet central banks are easing. This is bull market conditions. It does not get much better than this. Now, it's not a short-term call. Of course, things are buoyant today, but it's not saying they're going to continue at this pace, because they definitely won't.
What happens if the market doesn't get the rate cuts it now expects? The market has put this in the rearview mirror. This is done and dusted. We didn't get a big reaction to it. We'd already priced it in. What happens now? Because at the moment, the market is still expecting the Fed to be much, much more dovish than is priced by the dots.
They won't get the rate cuts that are priced. I just don't see it. It's going to be like in December. In December, we priced 6 cuts to have already happened by now. Went crazy, and yet the market kept on rallying, and the yield curve kept on steepening. And what we're going to see exactly again, we're going to see yields overall, probably even at the front end, go a little bit higher over the next coming months. But really, we're going to see steepening of the curve because the Fed have said a very, very clear message that whenever it's important, they only really have one mandate. They don't have a dual mandate. They don't really care about inflation. They don't care about inflation in a responsible, long-term, sustainable way. And therefore, they're complacent about inflation, and they care about the labour market. And that means they're giving another jolt to the economy. And that is positive for stocks. So the rate cuts will be slowly priced out over time, but they're being priced out because the economy is fine and stock markets are doing fine. Those rate cuts will only come in at such an aggressive level when a true crisis arrives. And there's no sign of one just now, especially now that the Fed has reignited animal spirits.
OK, so reigniting animal spirits. And what did that do to the dollar then, Mark? Because we saw it drop initially, as you might expect, on that bigger, outsized move in rates. But then it started to gain. It's down again today. But what does the trajectory look like for the dollar?
The dollar is the most difficult asset to call because the yen should weaken again. We're back in a risk-on environment. Carry trades will be reignited, and the structural reasons for yen depreciation have not gone away. Still, the only major economy in the world that's not expected to grow this year. Still got the world's largest debt pile relative to GDP. Still got the most deeply negative real yields. That's not changing. But the dollar will suffer against emerging markets, against high yielders, against commodity currencies. Net for the Bloomberg dollar index, it balances out.
OK, the clock stopped. I'm not quite done yet, so let's carry on the conversation. Is the next big risk event anything to do with the Fed? Can we park the Fed now and think about the election? And how big a risk is that election to your outlook for this bull market?
That's a brilliant question, because I think you're right, we can park the Fed for now. The Fed never goes away as an important driver, but it's not going to be the big derailing catalyst right now. If anything, Powell tried to sound a little bit more hawkish last night and push back, and they're already kind of presenting the idea of 25 basis point cuts out there. So I don't think the Fed is going to shock this market in the short term. So you're right, we can park it as a major negative catalyst. I do think the election provides many risks. Now, the base case is not set to be negative, but obviously as we get closer and closer to election day, there's a chance for something more dramatic to happen. But I think the structural backdrop here is just extremely positive. And part of the reason I kind of answered the first question with the bull market is that all the big macro inputs are pointing in one direction. We've talked about this many times this year. And until some of those change, that's growth, that's monetary policy, that's company earnings, everything is pointing very positive. Even the fact that energy costs are getting cheaper, it's getting easier for the consumer because inflation is coming down. Everything is pointing to supportive scenario for stocks. Some of those are going to start crumbling at some point, but more than one has to crumble. And there's not one obviously on the horizon. So expect volatility with politics, but not a derailing of the bull market.
We've talked about the Fed. We've got the Bank of England today, but after that we have the Bank of Japan. Neither of those central banks are expected to move on rates this time around. But I wonder what the Fed decision to go by 50 means for the BOJ, because at one level you could think it exacerbates that interest rate differential between the two, could cause more volatility. But I'm not sure if that is the case. What are we expecting from the BOJ?
Yeah, I think we've been looking for a load of reasons, kind of what's the read across from the Fed and influence in the BOJ. Maybe we're over-interpreting it. Maybe there's not much of a read across. The BOJ, as I say, wasn't expected to do anything. They were hoping to persist with their hiking cycle. I think their own problems are domestic. It doesn't matter if the Fed does 50 or even if they only done 25. The fact is the BOJ has a stagnant economy and does not seem to have self-sustaining inflation. So I think they're going to struggle to get away with many more hikes, even though they keep up that narrative that they're really persisting with that idea.
OK, and I think we get some more data out before we get the BOJ decision, so we'll see around the wage story. Thank you very much, Mark. As ever, Bloomberg Markets Live, Executive Editor Mark Cudmore with more than 3 minutes on the markets this morning. If you want more from Mark and the rest of the Markets Live team, MLIV Go is the function to use on the Bloomberg terminal, and they were busy all the way through the Fed news yesterday, the press conference, and all of its aftermath in through the Asia session and this morning into Europe. Lots of coverage of all of that central banking story. Let us get the stocks we're watching, though, this morning. Joe Easton from our equities team has a briefing. Good morning, Joe.
Morning, Anna. So we've got another really strong report out of Next today in the UK, raising its guidance once again, something we continue to see from Next, and the second time that they've done it this year. Now, they're seeing a big jump in their UK sales, but interestingly, also their overseas sales, actually better than the UK. But overall, this is a better-than-expected picture, given we've already seen some weak numbers out to the likes of AB Foods, the owner of Primark, also Marks and Spencer's, potentially wasn't as strong as expected. But in terms of the two-year chart I wanted to bring up on here, we can see the orange line is Next, a massive rally over the past couple of years, rebounding from that initial cost of living crisis plunge. But that is actually something we've seen across the entire stocks retail index, the white line on the screen there. Pretty much the theme, a rebound in retail. But if we look at the analyst ratings, one point to note is that 15 holds, only 5 buys. So a lot of brokers not willing to bet yet on a continued rebound for that stock, but this does look positive for the moment. Then staying in UK retail, we've also got Ocado, a big jump in quarterly sales there, up around 16%, and they've raised their outlook for the year ahead. They now say that their sales will be in double-digit percentage increase versus single-digit in terms of the guidance they're giving. If we look on a 1 year, though, that stock down more than 50%. This is more due to their automated warehouse business, though, that hasn't got enough orders. So today they're reporting their retail sales, so that might take the sting out of that. And if we look on a bit of a longer-term view on Ocado, we do see that actually the loss is even bigger. Look at that, down 73% over 5 years. It was one of those cult UK stocks that did really well. Obviously, the weakness in the warehouse business, the problem for that one, but the sales today looking pretty strong. Then finally, we're looking at miners once again. Morgan Stanley got a bit of a bearish note out today. It's all linked to China, unsurprisingly. They're saying that Chinese steel demand is not as strong as they would like it to be, something we've heard a lot of recently. So they go underweight on Antofagasta in the UK. Here's a good quote from them. Amidst China's disappointing steel demand indicators, a seasonal restock is likely. Antofagasta needs to deliver a big step up in earnings if it is to stay where the stock is at the moment. They've got a couple of other ratings out as well, but that's the one we could see weakness here. Here we've got the mining index, the basic resource index. We can see that decline over the past couple of months, all due to China. Morgan Stanley joining those bearish calls this morning. Keep an eye on Anto in London.
Thank you very much, Joe. Joe Easton with the stocks that could be on the move, drawing our attention to some news out of or rather a continuing of a filtration of China negativity into what we're seeing in commodities, which is of interest. It's not going to be a day maybe for individual stocks, though. I mean, futures are seen higher on what seems to be this bullish call post-Fed.
Yeah, and how should we read that price action? What is it really kind of telling us about where market sentiment is at the moment? I do think the individual stocks are worth paying attention to. The car sector, I think, is going to be fascinating today in the light of the data we've seen out across Europe, and it doesn't paint a sort of particularly pretty picture. That is a core part of the kind of the European economy. That's not looking particularly good at the moment. The next numbers, though, I think are really interesting in terms of what they're telling us about the sort of state of the high street. I know the market's not prepared to kind of push forward with this one at the moment, but those it looks like things are not falling off a cliff, certainly for the UK consumer at all.
How much higher will those UK retail names go at the open? We will bring that to you shortly. That is next. This is Bloomberg.
Thursday the 19th, a couple of minutes ago until the equity market session starts here in Europe. Can I ignore yesterday's session in its entirety? Is there a message that I should take forward from it? I think is an interesting question that we need to ask this morning. Europe basically did nothing yesterday. We were waiting for the Fed. We wait. We get the Fed. Then we get a really choppy kind of afternoon in the United States, which ultimately, though, sees equity markets rolling over into the close. Now, is that price action that I should take seriously? Was there enough time really for the market to digest and understand what Powell was telling the market? Or do I take on board the price action that I'm seeing this morning in futures, which is much more positive? So let's flip the board up and just show you what is happening with the futures pictures. Stocks up by 1.22 this morning. FTSE 100 futures up by 1%. Nasdaq futures are up by 1.73%. Now, Asia is having a big influence on the futures pictures at the moment. Now, remember, Asian equity markets were really strong overnight. Can I translate strong Asian markets into strong European futures and into strong US futures? And does this positive picture hold up into the US Open a little bit later on? I think it's going to be a really interesting session as the market around the world kind of digest differently maybe the reaction to the Fed.
And different asset classes giving their own spin on things, their own take. Mark Cudmore was talking to us about short-term volatility not clouding the long-term bullish picture for risk assets. We'll see where that takes US futures, which are pointing, as you say, Guy, higher this morning. On to individual stocks. Next in Ocado, very much in focus on the UK retail side, upgrading their guidance, both of them. There are still a lot of holds on Next in terms of the city and what it thinks this business can deliver. But how much will this lift the rest of the sector, the likes of Marks and Spencer's? We'll keep an eye on car makers as well, Guy, this morning.
We are, and the car data really weak out of Europe once again this morning. Right, here we go. It is time for the opening trade out of Europe. Futures are pointing us to a positive start to the session here in Europe, despite the fact that we did see that sell-off into the close in the United States yesterday. And let's see what we actually end up with this morning. The FTSE 100 is out of the gate. It is positive, but it's only up by, here we go, we're climbing now more positively, and the Stock 600 is up by 0.5%. Do we continue to get more positive over the next few minutes? Do these numbers continue to climb? The indications are from the FTSE 100 that we are moving up towards that expected, let's call it circa 1% move higher this morning. It's fascinating. Is this Are we taking our cues from Asia? Is Asia a better guide to the reaction that we should be taking, that equity markets globally should be taking to the Fed? I think it's absolutely fascinating. The CAC is out of the gate already this morning. It's up by 1.5%. Very strong story coming out of France. Spain's up by 1%. Anna, it is the positive start that we thought we would get, but didn't necessarily think we would get as we were looking at the US close last night.
Yeah, the US close was much more confused. Maybe Asia and Europe coming into this and just not overthinking it quite so much and saying, look, we've got 50 basis points from the Fed. Let's just dwell on that fact for a moment, shall we? And certainly that's what the sector breakdown looks like here in Europe. And I mean that in two ways. One, the fact that no sectors are in negative territory, so that tells you something about risk appetite. And secondly, we've got even basic resources going higher. I mean, that's a sector that often moves around with the China dynamic, but we've seen Asia stocks jumping on the US rate cut story. And that's lifted Asia stocks. And now we've got basic resources here in Europe. That sector higher this morning, up by 2.3%. But a number of sectors up by more than 1% today, including energy, consumer products and services, which did badly yesterday.
Yep.
So, the stage was set yesterday here in Europe for something much better today because there was a lot of negativity in the price action yesterday.
Next is up by 4%. So those that didn't believe maybe believe a little bit more this morning. The upgrade to its numbers certainly being taken positively by the market. So that stock is doing very well. You're also seeing the luxury names doing very nicely as well. This is the stocks 50 that you're looking at there in terms of the performers on the screen. As you can see, the luxury names being driven higher. Is that an Asian trade story? Is that a dollar story? What is that? But certainly you've got Richemont, LVMH, Hermes, all moving up really quite nicely this morning. That is where we're seeing this significant strength. On the wider stock 600, you've got Next doing well. Norsk Hydro is trading strongly as well. Worldline, Delivery Hero, all up quite nicely. Swatch Group in the mix as well. So investors digesting around the world this picture as to what we got from the Fed and what that picture really is. Let's listen to how some of them have been telling us about their thoughts about what happens next and that 50 basis point cut.
Here's the headline. Fed cuts interest rates by 50 basis points and the bond market returns are going to be negative today.
This was a huge victory for Jay Powell, who really laid out at his Jackson Hole speech that he was worried about employment. And that is what this is about.
The market's going to look at the median dot and will interpret this as a dovish 50 basis points cut. And the first reaction was actually a steepening of both 2s10s and 2s30s, which tells you something about what people are worried about.
We would have liked to have seen the median dot for the end of next year somewhere around 2.75% to 3%. But otherwise, as we had been guided over the last week, nothing to quibble about.
It's pretty much what I was expecting, in the sense that one of the issues that Powell had is how do you do 50 without scaring people that you know something bad about the economy. And I think he did that very well. He basically said, we're doing this because the news is good.
Joining us now to add her voice to this conversation, Kim Crawford, Global Rates Portfolio Manager at JPMorgan Asset Management. How do you see the price action?
I think it makes sense. The Fed gave us, I think Powell put it really well. It's a good, strong start. You know, there is sufficient progress in inflation, and then you had a more threatening slowing in demand in the labour market. So given the balance of risks, makes sense to get out of that really restrictive territory just quickly to give that market comfort that your hand is on the trigger, ready to go, and to support the labour market.
OK, but how close to the trigger is the hand at the moment? Because certainly the message seems to be we've done 50, but don't assume that you can extrapolate that forward.
Yeah, I think they wanted to send the message that it is a recalibration cut. Powell told us that there's nothing in the economic projections that suggests that the committee really is in a rush, but that they will speed up if they need. They will slow down if they need. They will pause if they need. So I think the Fed is very sensitive to the labour market. We think they probably are indicating more 25s, and then I think they're going to have to go consecutive from there, but in 25s. But they are very sensitive. If they're going to see further weakness in the labour market, they will speed up to 50 again.
Kim, tell us about bear steepening of the Treasury curve, because we saw a bit of that after this news dropped. Is that something we're going to see into the future, or is that just a part of that knee-jerk response? How would you expect bond markets to position out of this?
Yeah, I think I view that more as a washout of positionings, a bit of profit-taking in long-duration positions that are further out the curve. I think the curve is going to continue to steepen, but the big move is going to be bull steepening. For that, you're going to need the market to flirt more with that recession narrative, which I think it can do over time as the data continues to weaken. And that's why I think as well, you're pricing 25 you're pricing more than 25 for the rest of this year, even though the Fed has told us 25. You've got to have a bit of that recession risk in the market.
Do you think the market is going to... We were talking to Mark Cudmore about this earlier on then. So do you think the market is going to move the Fed closer to its way of thinking, or the market's not going to get all the cuts that it's pricing in? Because it's pricing in 50 basis points more by the end of 2025 than the dot plots.
Yeah, I think the market pricing is fair, and I think the risk is that they might have to deliver more. The Fed's going to have to deliver more. So I think it's more likely that the Fed moves towards the market, but it's going to be the data that ultimately tells us where we're going. I think, our base case is still a soft landing. I think in a soft landing, you can still see more cuts. And the reason for that soft landing is that the Fed gets the message. I think we have, what gives us some comfort is a slowing, still very low level of layoffs.
Yeah.
I think balance sheets are still very strong. And I think leading indicators are showing cooling and not collapsing. So I think that combination together, I know it's very rare, as history tells us, for the labour market to really just stabilise from here. But those things are things that give us comfort, at least for the next
This is the bit
months.
that I don't understand. The market's signalling recession, and I hear that kind of that recessionary kind of element in what we're seeing in terms of the way that the curve's developing. Powell sounds really confident that he can stick the soft landing.
Yes. I mean, that just goes to how difficult a message, I suppose, it was to deliver. I mean, we heard Dudley was convinced, wasn't he, that Powell had delivered the message very well. You sound like you understood exactly what was trying to be communicated there, Kim. But at the end of the day, he was delivering a really big cut into an economy that he says is doing OK.
Yeah.
And, I mean, does that explain why we see different asset classes responding differently to the messaging of yesterday?
Yeah, I think, they gave us the 50. They told us it's a recalibration. And I think what the bond market is saying is we're not really worried yet that this is going to really cause a reacceleration or reignite inflation.
Yep.
And that makes sense to me. I think we forget that sometimes 3-month annualized inflation is actually below the Fed's forecast right now. So we spent a lot of time this year talking about upside risk to inflation. No one started talking about downside risk to inflation yet. And I think also the question of whether this is going to reignite is more relevant if we are closer to neutral. We're currently still in very restrictive territory. The Fed tells us neutral is around 3. We'll put heavy bands of uncertainty around that. But even after yesterday's cut, we're still just below 5%.
I kind of feel like I'm done with the Fed now. We've spent a lot of time over the last few weeks talking about the Fed. I just wonder whether we need to move on to politics now. Because the biggest risk, certainly to the long end of the bond market, has to be now that we see a much more inflationary Trump presidency, a marginally more inflationary Harris presidency coming through in the United States. If Trump comes through, the policies he's talking about at the moment feel inflationary. Is that the bigger risk now to the bond market than whatever the Fed is talking about doing, saying?
Yeah, so I think, we've got some time till the elections. They are a lot closer now. But I think the data is still going to drive us till we get to the elections. And I think that's because we need to see something in the data that's telling us that the economy is not continuing to roll over. That will then shift those election pricings forward, or a big shift in election probabilities. I agree with you that if we get a Republican sweep, that's going to be the biggest risk to bonds. It's going to be higher yields, I think, if we take Trump at his word, tariffs, immigration, tax cuts, deregulation. I do think the impact on growth is arguably more ambiguous, but you're going to see higher yields. And if we don't get that sweep, then I think on net you possibly see lower yields. The impact of tariffs, but not enough on growth to support on the other side.
What do you see in gilts?
Gilts are interesting. I think the Bank of England is just in such a different place from the Fed right now. Not to say that in a few months' time they won't be in a more similar place, but the inflation narrative is just still so different.
Doesn't feel like it's made the journey yet. The Fed's made the journey from worrying about inflation to the labour market. The Bank of England hasn't made that journey at all yet.
Yeah, and I think that's fair. The balance of risk just haven't shifted like the Fed. I like to look at 3-month annualized inflation just to get a feel of near-term momentum in inflation. If I'm looking at core, UK, we're about 3.8. US were 2. Services were at 4.8. The US were more like 2.9. And on wage growth, we're at 5.5 in the UK. And that's only 3.5 in the US. So the Fed can have a lot more confidence that the battle with inflation is done and shift their focus to the labour market. But the Bank of England just can't do that yet.
OK, so the Bank of England is behind in terms of its ability to move on to the labour market dynamics. Someone that, a region or a country that is way out in front and very much has its own dynamics, I accept, is Switzerland. We saw them cutting interest rates really early, and inflation has been quite weak because of the strength of their currency. But I just mentioned this morning because we've got a new inflation assessment out from the Swiss government today, and I just wonder if it tells us something about how even risks to the downside on inflation coming through, because the Swiss government saying 2025 inflation in their assessment, they're putting it at 0.7%. The prior forecast was 1.1. There's quite a big downgrade in their assessment of inflation. And is this... OK, Switzerland's its own special case, but do we, at some point, do we need to start worrying about risks to the other side of inflation? We've been so obsessed with high inflation in the last year or so.
Yes, I think this is where it's going to get interesting for the Bank of England and the ECB next year. I think there's a big indexation issue in the UK and Europe. And a lot of that number is going to come out quite swiftly from base effects next year. And I think in Europe especially, we've got much bigger downside risks to growth that are showing through in the data. The ECB can't move yet because it's got an inflation mandate. Inflation is still sticky. We've got delays in wage negotiations, labour hoarding, still keeping the labour market pretty OK, and prices still pretty high. But I think they're going to have to speed up next year faster than what the market's expecting, precisely because you're going to get suddenly those downside misses to inflation versus forecast and weaker growth as well.
Yeah, it's not a great combination. But they don't have as much room to manoeuvre, maybe, as the Fed does in terms of the way they can cut. Kim, nice to see you. Thank you very much indeed for stopping by to see us. Kim Crawford, Global Rates Portfolio Manager at JPMorgan Asset Management. Thank you very much indeed. This is what the Core 6 looks like this morning. Luxury stocks definitely on the front foot. We're seeing that strength coming across Europe. As you can see, LVMH up very nicely, up by 2.77%. Elsewhere, we are broadly higher. There's very little in negative territory this morning. We are seeing some of the retailers in the UK having a very strong morning. Joe Easton, what are we watching?
So it is a big day for retail, as you say, though. We're actually seeing the stocks retail index hitting a record high now. Data going back more than 30 years. That index is trading at a record. Part of that move is due to Next in the UK. That jump in sales guidance, once again upgrading their view on the year ahead. And we're also seeing a big move higher in Ocado. The stock is up around the most in a year for Ocado. Now, bear in mind, down heavily on concerns around the automated warehouse business, but the retail sales out of the company, the partnership with Marks and Spencer's, looking really strong. We're up 14% on Ocado. Next, up around 4% at the moment. One stock going the other way is Allegro over in Poland. This is a retailer as well. Really weak guidance out of them this morning. That one absolutely slammed. But we're going to take a look at shiny, posh watches, because Guy mentioned luxury doing well today, but watches doing particularly well. Data out of Switzerland showing a big jump in Swiss watch exports. Really a defensive part of the market. Rolex, Swatch, those kind of products tend to be pretty steady no matter what the economy does, doesn't it? But that area of the market looking pretty strong today. Then in terms of M&A, there's a little one in the UK. Not sure if we've got a price yet. We've got a massive unch on the screen once again, which means we haven't got a price. But take my word for it, this stock is going to rise because Capital & Regional, it's a real estate company in the UK, takeover bid from New River, another real estate property takeover in the UK. Really an interesting sector. And then Close Brothers, earnings out of them, but they're also offloading their asset management business. This is the company that owns the Winterflood stockbrokers in the UK as well. And our daily check-in on Commerzbank, there's a report saying they're looking to push on with a change in CEO. So we're keeping an eye on that one amid the UniCredit interest. A bit of rare red on the screens there. Commerzbank coming down today. Then in terms of some of the mining stocks, there's Anto. Now, even with that Morgan Stanley underway, it's still gaining, given the positivity around the Fed, around interest rates. So we're seeing green across the screen now. Guy did mention Norsk Hydro earlier. That one is actually an overweight over at Morgan Stanley. They like that one. They like the two down the bottom, Norsk and Rio. They dislike Anto and Boliden. But look, green across the screens, everything rising, giving the focus on the Fed. One stock going down, though, Deutsche Telekom. Now, remember, this company owns T-Mobile in the US. T-Mobile numbers weak last night. Cash flow looking really poor on T-Mobile. So that is hitting Deutsche Telekom. So we can find some red on the screens if we look close enough. So that one coming down. And then another one, another Deutsche, this time Deutsche Post. This one is downgraded today to underperform over at Exane. Now, Exane predicting that Deutsche Post will do a profit warning in the next couple of months because of weakness in some of the freight markets. So that one coming down. Most of the screens are green, but a couple of stocks declining today on the early trading.
Thank you very much, Joe. Yeah, I was just looking at that Deutsche Telekom share price and wondering why it was bringing the whole telecom sector down, and here's Joe to explain it to me, so thank you very much. Joe Easton with the latest on those individual stock moves. Coming up, we'll talk more about the car sector. Germany EV sales slumping in the latest piece of bad news for the region's biggest car market. Some really tough comparisons with last year. We'll talk about what's happened since. More on the embattled auto sector next. This is Bloomberg.
80 minutes into the equity market session, let's call it 19 minutes. This is what the picture looks like. A little bit of a fade, maybe from the early indications that we're going to see kind of 1%, more than 1% across the board. France is doing well. The reason for that, we are seeing luxury stocks having a very strong start to this morning. As Joe was pointing out just a moment ago, watch stocks in particular are having a good day both in France and in Switzerland. But luxury stocks more broadly, the heavyweight names like LVMH, Hermes doing very well right now. Let's talk about what is happening with the macro picture. We move our attention from the Federal Reserve yesterday to the Bank of England today. The BOE likely to decide, we understand, against cutting UK interest rates. That will be the second straight meeting that we have seen it. The last meeting was obviously interesting in terms of the vote split. What are we going to see today? Joining us with a preview is our UK correspondent, Lizzie Burden. She's outside the bank. So 50 basis points from the Fed. Can I extrapolate into the room at the Bank of England where the meeting is taking place? Will they pay any attention to that? Or is this a domestically focused Bank of England right now?
I'm sure that they'll be paying attention, Guy, via the exchange rate. But look, the movement was already priced. The expectation of that half-point cut from the Fed meant that traders did already ramp up their bets for a cut from the Bank of England today. But look at the flip side of the argument. In a way, Jay Powell's already done the work for Andrew Bailey yesterday. And he managed to pull off the messaging about a soft landing, perhaps. So there's no need to fret on Threadneedle Street. On top of that, you had the services inflation reading yesterday spiking, which is a cause of concern for the Bank of England. And you had Andrew Bailey at Jackson Hole sounding cautious. So that's why economists still expect a hold from the BOE today with a less finely balanced split than last time. 7.2 is what we're looking for. And actually, most economists reckon that the pace of asset sales is going to stay the same at £100 billion a year. But that part in particular will be watched closely by the new Chancellor Rachel Reeves as we head towards her October the 30th budget.
Yeah, we were talking about that unfortunate linkage between monetary policy decisions on the balance sheet and fiscal headroom. We were talking about that with Jens Larsen earlier in the programme, Lizzie. But in terms of the basics of monetary policy and the path ahead for rates, is November in play then now? Are we expecting any clues from the bank around November? I'm not sure we hear all that much from them today.
No, we don't. We don't have a press conference. We don't get updated forecasts, but they might nod in the guidance to lower inflation and lower growth given the recent data. The reason that November will be more interesting, and indeed traders are pricing in cuts for November, December and 5 in 2025, is because we'll have more data and a budget on October the 30th. And at the moment, it looks like Rachel Reeves is going to try to plug that £22 billion hole in the public finances. And there's speculation that to do that, she will raise taxes. So if there is a fiscal tightening, many are wondering whether markets have yet fully priced in the slowdown effect of that budget on the UK economy.
OK, Lizzie, thanks very much. Thanks for the briefing. Bloomberg's UK correspondent Lizzie Burden outside the Bank of England, of course, for us. Let's pivot to the German economy right now. And one dynamic there we need to keep across is what's going on with the car sector. Germany has led a drop in European car sales. Deliveries were dragged lower by EVs, which plunged 69% in the year to August in the region's biggest car market. Let's get more then with Bloomberg's Oliver Crook, who's been, of course, following the auto sector, following the German economy, and can bring those two together for us. Ollie, good morning. So more bad news then from the auto sector.
Yeah, I'm sad to report today that the month of August was a very bad month in terms of deliveries across Europe. If you look at just sort of the headline numbers, the sales of cars generally in Europe fell by 16.5%. When you drill down into the countries that were most sort of influential in that, you go to the biggest economies in Europe. You go to Germany, you go to France, you go to Italy. Germany sales were down about 30%, France about 25%, and Italy down 13%. When you look at what that means for the year-to-date figures for both Germany and France, this August figure basically wipes out all of the gains this year so far. So their car sales year-to-date have grown 0%. When you look at the different brands and how badly everybody else was affected, you go to Volkswagen, their sales were down 13%. Which is actually relatively good compared to Stellantis, which saw sales diminish by 30%. BMW 15% down, Mercedes 10% down, and of course Tesla down 36%. And so you're seeing a moment here in the economy within Germany, but of course the broader economy within Europe, where you're really seeing these car makers struggle severely, whether it's BMW on that recall, but of course Volkswagen talking about closing factories in Europe for the very first time. They're also closing factories in China in some of their joint ventures with Cites. That's news that we've got out fairly recently. So again, fairly grim picture in terms of demand.
Ollie, we're meant to get rid of ICE engines by 2035. Looking at today's data on EVs, is that going to be possible? Does Europe have a problem with its targets?
I think they may very well, and you're going to hear a rising chorus around that if you just look at what we saw in terms of the EV market. If sales were bad across the board, they were really bad for EVs. You look at the EV sales across Europe, they were down 36% in the month of August. That means that for the year to date, they've been down 6%. And again, drill down into these markets. EV sales in Germany down 70%, down 69%. In France, down 33%. This is all in part to do because they got rid of a lot of incentives that were there for EVs last year. So the year-on-year comps are not great. There is one bright spot, Guy, and that is the United Kingdom, where EV sales rose by 11%. The year-to-date figure there also up 11%. So the EV story still intact, at least in the United Kingdom. But when you look at this sort of across the board, gas versus EVs, there is one clear winner, and that is hybrids. It was a poor month for gas cars. It was poor for battery electric. When you look at hybrids, August sales for hybrids up 8%. Year to date, they're up 20%, guys.
Yeah, I wonder if people still just look around and don't see the infrastructure that they want to see to make that full leap. We just briefly, Ollie, we might see some action by policymakers on various fronts. I know there's been a lot of conversations about the tariff level on Chinese cars. Those conversations continue this week. We get a decision next week.
Yeah, absolutely. So the member states and the EU still need to sort of vote on this with grand finality. Of course, there was sort of consensus build-up, though there were some people that were kind of resistant to it from the beginning. We know the Germans, for example, were kind of resistant to it. They had a lot of objections even at the Scholz level. They kind of backtracked a little bit. But then you had Sanchez coming and saying, we actually don't know if this is such a great idea from Spain. So sort of interesting, that debate going there within the EU presently.
Ollie, great stuff. Thank you very much indeed for updating us from Berlin. Ollie Crook on the auto sector. The tennis season's Grand Slams are behind us, but the sports superstars are now descending on Berlin, where Ollie Crook is for the Labour Cup. Our own Mr. Crook caught up with the former #1, John McEnroe, who's criticising the distribution of money within the sport of tennis.
After, the amount of money that's paid at the U.S. Open, which is record money compared to what we were getting, 14% of, and that's including the women, out of the revenue. I mean, that doesn't seem to be totally fair, and that happens at all the big events. And I don't want to, I don't think you have enough time to get into sort of the machinations of what goes on, but let's just, needless to say that we're just like hired guns.
Welcome back, everybody. This is the opening trade, 30 minutes into Thursday's session here in Europe. And post the 50 basis point cut from the Fed, it seems that risk assets are to the fore. Stocks are higher this morning. We're up by 1.2% on the French market. Luxury stocks, consumer products not doing too badly. Basic resources lifting. London, that sector doing OK. Retail also getting some good numbers out of the London suite of corporates. And so that sector doing OK this morning. In fact, only two in negative territory, utilities and telecoms. US futures also looking higher. E-minis now up by 1% this morning. Let's talk about what the Fed cut means and look beyond to market positioning. We'll talk to John Bell, Portfolio Manager on the Equity Income team at Newton Investment Management. And a real pleasure to have you with us, John. Thank you so much for coming to talk to us on set here. So let's talk about the here and now and post the Fed. You know, what is a 50 basis point Fed rate cut? What is it good for? Seems to be good for stocks here in Europe at this point.
Well, first of all, thank you very much for having me. I think that the market got what it was looking for, didn't it? The expectation was that we were going to get a 50 basis point cut. I think the initial reaction was positive, and then we sold off a little bit, perhaps, as we listened to Mr. Powell saying this isn't necessarily the path towards some significant rate cuts, and now things are rallying. And I think what we're seeing is a belief that the Fed has got everything under control, that they're going to engineer a soft landing, and therefore risk assets are moving ahead quite strongly.
Yeah, I mean, if this is good for stock prices, is there less need to go looking for yield? I know that, you know, that's where your portfolio focuses, but thinking about it in relation to other things, is there sort of less need for it if we're going to see stock prices go higher?
I think the macro and the Fed is one thing. That's clearly very important to the backdrop. But I think there are other factors that we need to look at, positioning and valuation. And certainly positioning had got very, very extreme. We saw midpoint in the year. It didn't take much in terms of the BOJ raising rates to unwind a carry trade, create some panic in markets. And I think really the key to that is that people are very positioned strongly towards growth, and people are very much positioned towards technology and other areas of the market where valuations are high. So we would argue, actually, that there is a need for income, but income as a diversifier against growth portfolios. Given the valuation of growth, given what happens when there's a little bit of uncertainty, the sell-off that we saw was very rapid, that there is a clear role for an income-related portfolio as a diversifier of equity risk.
Defensive stocks have done really well recently.
Yes.
You're long defensive stocks. Yes. Are you lightening up on defensive stocks?
Yes, absolutely. I mean, if you look back again to that midpoint in the year, we had perhaps our most extreme positioning ever. We were the most overweight utilities we've ever been. We were the most overweight financials, the biggest underweight we've ever seen in technology. And as you say, positioning has moved very much in that direction subsequently, and as a result, we've tempered that position. So we are still overweight those sectors, but by less than we were at that point.
Just thinking about the Bank of England today.
Yes.
Is cash still a headwind? Is cash still an opportunity if I'm an income-seeking investor right now, and how much of a headwind, therefore, is it to you? You're still getting kind of 5% circa out of a money market fund here in the UK.
Yes, and I wouldn't necessarily expect, you know, more broadly, a very dramatic rate-cutting cycle. I think the flexibility of central bankers is reduced somewhat by higher and likely more persistent inflation. So it is an asset that has some attractions. I think the big difference between equity income relative to cash and fixed income is that we have the ability to see dividends raise, the income to go up, and therefore help to generate an increasing income stream that you wouldn't necessarily see.
So what are you getting just in terms of income? What am I getting relative to cash at the moment? What's the kind
of... About 3.75% is the yield on the portfolio at the moment, so relative to an equity overall yield of 1.9, so significantly higher, and then a growing income stream on top of that.
And thinking about the sector positioning within that, and you talked about how, yes, in the middle of the year, when everyone was so, you know, peak excitement around AI and the Magnificent Seven had done so well, and then since then things have come off a bit, and we know that. How do you position around technology now then, given the sell-off we've seen? And actually, just looking at your top 10 holdings in your global income fund, there are tech names in there. They're not necessarily the ones who make the chips, but they are technology related.
Yes, well, we're still significantly underweight, and part of that is because we have a very strict yield discipline, which means effectively we can only own companies that have a higher yield than the market, and that makes our tech universe somewhat restricted, and in many ways that explains why we're so underweight. But we can still get exposure either directly through companies like Cisco Systems, Samsung Electronics as well, which is semiconductor related. Memory, of course, but we can also get exposure to the pace of technological change through other businesses. The advertising holding companies, for instance, which in many ways are technology businesses, using artificial intelligence, using big data to produce content more cheaply, to produce more targeted marketing campaigns, but they are being valued as if they're no longer relevant, whereas many of the technology companies are being valued much, much more aggressively.
How do you see technology companies and their attitude to dividends? How is that evolving? Is it evolving, or are companies just getting older and maturing and therefore deciding to pay dividends in the way that companies in any other sector would?
There is less yield, clearly, coming from technology companies. I think the yield on Nvidia is 0.03%. I've never had to look to the second decimal place to find a yield before. But so there is some culture of dividends. I think there's probably more of a culture of buying back shares, in keeping with much of the US market as well, as a means of returning cash to shareholders. With maturity, we may well see more dividend payments, but I think these companies still are very much set on reinvesting and growing the business as fast as they can.
So somebody like Microsoft, you know, I think there is return of cash to shareholders there, but that's because of its maturity.
Yes, and we historically have owned Microsoft. I mean, there was a period when Microsoft had a yield significantly higher than the market, and people viewed it as an obsolete company, that it was going to be replaced by other operating systems. It was clear to us that was never going to happen, and we were comfortable owning the shares. Subsequently, they performed very strongly and much more highly rated.
Are banks going to continue to be income generators? What happens on the tax front? Is there going to be a threat?
Yes, I mean, if you look at our financials weighting, it's dominated by non-bank financials, insurance companies, exchange-related, so volatility-type plays. We do have some banking exposure, none in the UK, topical as to whether there may or may not be a windfall tax on banks. They are and have always been relatively high-yielding companies. We have more exposure now than we would have done historically, because the regulation, I think, is a bit more favourable. The bond, the bond market environment is also, the yield environment is more favourable. But we would caution that that banks always remain a politically difficult
So do oil stocks. What do you think of them?
Yes, we're limited exposure. We are marginally overweight to energy. Very good income-generating sector. Somewhat uncertain future, perhaps, given the energy transition. I think it's interesting that the big integrated companies in Europe are perhaps pulling back from that energy transition to focus more on their core business. That's a very logical thing to do, I think, in terms of return profiles.
Precisely,
but what does it mean for the long-term dividend streams from these companies?
What's at stake, John, when we look ahead to the budget, end of October? What's at stake for either the companies that you invest in or the companies you've got on your radar to invest in? Do you see it having an impact on UK corporates that are on your radar?
We're not really investing on the basis of what might happen in the budget, what might happen in the US election as well. There's obviously a lot of political events coming up towards the end of the year. I think really all they do is serve to reinforce the broader thematic macro backdrop, which is one of geopolitical uncertainty that we would sort of capture under the title Great Power Competition, the battle between liberal democracies and autocracies, the growing size of the state, the intervention in markets. We're likely to see more of that, and broadly we would argue that is an inflationary trend, which brings us back to interest rates and the flexibility of central bankers to react to slower growth, react to markets with aggressive rate cuts, which we don't see happening.
OK, John, thank you so much for joining us. John Bell, Portfolio Manager on the Equity Income team at Newton Investment Management. Coming up on the programme, a new wave of exploding telecoms devices in Lebanon ramps up tensions between Israel and Hezbollah. We have the latest from the region. That conversation next. This is Bloomberg.
Welcome back. You're watching the opening trade. 43 minutes into the equity market session. We faded a little bit more, as you can see. We're definitely off our early indications of kind of 1.5%. We're kind of now up by 0.75%, as you can see more broadly across the picture. And we walk our way slowly, I think, towards the US Open, which I think is going to be really interesting in terms of where we're priced currently in the United States. The fair value on the S&P is kind of pointing us towards a rise of around 1.3%, which is much more positive than the negative close we saw yesterday as we came through to the end of the US session. Let's talk about the geopolitics and what is shaping up to be a difficult story in the Middle East once again. More telecoms devices, including walkie-talkies this time, have exploded in Beirut and in other areas across Lebanon. The country's health ministry puts the total death toll now at least 26 people. Israel's military has declared a new phase in the war and says troops are now to be diverted towards its northern border. Can we connect these two stories? Jumana Basetchi, our Horizons Middle East and Africa anchor, joining us now. That's the question that everybody's trying to figure out right now. Are these two stories interrelated? How should we think about one relating to the other? Talk us through what happened yesterday and how we should think about it.
Yeah, the perception is the two are very much related from the region, even though Israel hasn't directly acknowledged the series of operations that have taken place in Lebanon. But we did hear from the Israeli Defense Minister, Yoav Gallant, yesterday saying that the center of gravity is moving north. They are allocating forces, resources and energy to the northern area, that they are start of a new phase of the war and we must adapt. The background of this, of course, is that Lebanon has been rocked by 2 days of telecommunications infiltrations with communications devices exploding. What we saw yesterday was the catalyst for the explosion were actually walkie-talkies used by group members of Hezbollah that detonated, setting off fires in cars, shops, people's homes. The health ministry, as you said, has put the number of casualties from yesterday's attack at 450. The number of deaths have climbed to 20. And this, of course, comes after those wave of pager explosions that happened the day before, injuring up to 2,800 people and killing 12, including medical workers and 3 children. But of course, lots of speculation as to how this could have happened in the first place. But experts do say that at some point in the manufacturing process, explosive material would have been put into these devices that were then shipped onto these Hezbollah group members. And what it means now is Hezbollah are on the defensive, and so are other countries in the region. Iran, Syria, also on high alert vis-a-vis their own wireless networks as well. One thing to watch out for, the Hezbollah Secretary General Hassan Nasrallah is giving a speech at 5 p.m. local time today. So we'll be watching closely to hear what he has to say.
Yeah, we'll certainly see what he has to say then, Jumana. Now, Anthony Blinken, we know he's been in the region. I think he's meeting with foreign ministers from across Europe today. The United States and many other Western partners not wanting to see this turn into any more of a regional conflict than it already is. What sense of escalation do we see, Jumana?
I think it was pretty interesting that the U.S. Secretary of State Anthony Blinken, who had been in Cairo to push forward the negotiations on the ceasefire, was asked about the operations and the explosions that happened in Lebanon over the last couple of days. And he said that the U.S. had no knowledge. This is a direct quote. The United States did not know about it, nor was it involved in these incidents. We're still gathering the information and gathering the facts. Therefore, that sort of illustrates that the U.S. were not aware that this operation was going to take place. He also then added that the U.S. would like to see a de-escalation on all fronts, that their goal at this point is to get that Gaza ceasefire across the line, because that is going to be the catalyst for the de-escalation of tensions in the region. Yeah. But of course, we also heard from the Israeli Prime Minister Benjamin Netanyahu 2 days ago saying that they have expanded a new war objective, and that is to bring back security in the north. So big question marks about what they're thinking and how they're planning on making that happen.
Okay. Let's just talk about that objective. Security in the north. The objective in Gaza was the elimination of Hamas. What is the objective in the north? What does that security look like? Is it how far can they push back Hezbollah? What does this conflict look like? We remember what happened in the 1980s. How far is Israel prepared to go?
And that is the big question, because what is happening right now is there is pressure on the Israeli Prime Minister from his citizens, from the public, the thousands of citizens who've had to move away from their homes in the northern part of the country because of the daily exchange of crossfire that's taking place on the northern border with Hezbollah. Similar situation in Lebanon, by the way. Many families, thousands of families have been forced to flee and be evacuated as well. This has been going on for almost a year now. There is fatigue setting in. And what Netanyahu is saying to his public is they want to do something about the security. How far they're willing to go. They say that they're deploying troops at the northern part of the country, but of course they will then have two fronts waging on with the ongoing war in Gaza. Is there going to be appetite to put troops on the ground in Lebanon is the big question. But ultimately what they're trying to do here, Guy, is to push Hezbollah back away from the border. There was a resolution called UN Resolution 1701 introduced after the 2006 Lebanon-Israel war that stipulated Hezbollah have to put down their arms and move up north of the border. They haven't abided by that security resolution, but I think there's going to be a lot of pressure now from the international community to do something about that arrangement.
Jumana, thank you very much for the update. Bloomberg's Jumana Besetcha in Dubai. So oil prices pushing higher today on Middle East tensions, also some of the risk-on sentiment we're seeing post the Fed. That takes us on to the monetary policy conversation here in the UK as well. Let's think about where the UK goes next. Interest rates are expected to be held at 5% by the Bank of England when it makes its decision later today. For more, let's bring in Dan Hansen, Chief UK Economist at Bloomberg Economics. Dan, good morning to you. So, I mean, the decision is not necessarily the interesting part here. Do you think we get any guidance around November, explicit or in passing? Where will you be looking for clues?
Yeah, I think one way to gauge whether November... I mean, I think November is really live, given what we saw... Well, given what we've heard from the bank and also given what we saw yesterday from the Fed. If you want to look for something that from the bank that sort of confirms that, in the minutes, if they point to the November forecast round, the fact that they'll take everything into consideration then. They did something similar in June, pointing to August, and we got the cut in August. So if you're really looking for something to confirm your prior, that they'll cut in November, I would... obviously in the minutes, in the guidance. To be honest, I don't think the bank are going to really change the message today. There's going to be an ongoing point about caution around services inflation, around inflation persistence. Perhaps the bigger question will be around what they do with QT. You know, what envelope do they go with? But I think, to answer your question directly, if you're looking for a sign November's coming, they'll point to the November meeting and the forecast round and potentially taking a new view around inflation persistence.
Let's talk about that inflation persistence. The Fed, I think, can reasonably say we can put that one to bed.
Yeah.
The Bank of England really can't. It feels very sticky in the UK right now and looks like that process is going to continue to be with us for quite some time, sticky inflation. How far can the bank go in cutting rates as long as this dark cloud of inflation is hanging over it? How should we think about the cadence, the kind of the cycle that the bank can deliver with this story still overhanging it?
Yeah, it's really difficult because I think you're always worried as a central banker about fighting the last war. And I think the way the Fed has shifted now, they've been able to do that because I think a lot of it's to do with their mandate. It's very different to the banks. It's a dual mandate. So they can put a lot of weight on that labour market side of the argument. The bank is 2% inflation, and it's as simple as that. There's a secondary element to it where they have to support the economy, but it's 2% inflation. So for us at the moment, it's about a quarterly pace of cuts. It's not about a meeting-by-meeting pace. We saw the inflation data yesterday. It's moving in the right direction, but it is moving extremely slowly. You know, 5% services inflation is not going to get you 2% inflation in the medium term, and that's what they're worried about. I think what will be interesting is the latter half of this year into the early part of 2025, what you'll get is headline and core inflation converging. And at the moment, it looks like it's going to converge in and around 2.5–3%. So then you've got the question then. You know, are you willing to sort of look past that and be like, oh, we're just going to carry on? Or are you going to say, look, this is the final part, this is the hard yards. And at that point, there is a very different conversation. As you say, it's sort of, you can probably put it to bed in the US. Here, we're just not there yet. So it feels to me like a quarterly pace at the moment.
So quarterly pace. Would the cuts come more quickly or maybe bigger, but just maybe more quickly than quarterly if we saw sizable tax increases in the budget? Link the two for us.
Yeah, I mean, well... OK, so, I mean, the first thing with the budget, I think the thing to remember is that all of these tax rises appear to me to be, they're coming to pay for higher spending. So it's not about austerity, it's about a balanced budget. So if you're the Bank of England, am I thinking, is that going to impact demand? Not hugely. If Rachel Reeves decides to tighten fiscal policy significantly, not increase spending, then yes. The question then goes to what taxes she increases. And if it is focused around wealth taxes, actually the demand impact is relatively small because in economist jargon, the marginal propensity to consume of those individuals is relatively low, so the hit to the economy they can absorb the hit of higher taxes. So I think it's an interesting one, and actually it's another argument for waiting to see the budget, to see exactly what the fiscal strategy is, and then moving potentially in November.
The housing market feels like it's getting a new lease of life at the moment.
Yep.
Is that sustainable? Like if we're seeing a quarterly cut in interest rates, is that enough to keep the kind of the acceleration that we're seeing at the moment on track? Because that has a meaningful impact on people's perception of their wealth and their ability to go out and spend.
Yeah, and it is about, you're right, it's about perception. I think it is just about enough, the way we're going at the moment, to keep it on a relatively modest upward trajectory. I don't think we're going back down. I mean, one thing that's happened recently, given what's happened with the Fed, is that swap rates have fallen quite significantly in the UK. And obviously, that's what matters for the mortgage market. It isn't what the bank does meeting to meeting, because almost everyone's on a fixed rate, not a variable rate. So actually, there's been a bit more impetus put into the housing market again by what's happened globally. So I think over the sort of 6 to 12 months, there's no real reason to think house prices are going to go anywhere but upwards, even if it's just sort of 2 to 4% growth rate, nominal growth rate over that period.
I got an unsolicited phone call from an estate agent for the first time in a number of years the other day, asking if I just want to sell my house. You know, if that's the side of anything. So, Bank of England in focus today. Dan, thank you very much. Thanks for joining us. Dan Hansen, Chief UK Economist for Bloomberg Economics. Thinking about what is ahead then, Guy, yes, we have the Bank of England rate decision. We also have a Norwegian rate decision, no expectation of change just yet there. And also from Turkey and South Africa, of course. Then we get some US data and some ECB speakers and FedEx earnings.
You're quite excited about FedEx earnings, aren't you?
I always get excited about FedEx earnings. You know, sometimes they just throw you something interesting on the US consumer.
But that's where it's about. That's the story. That is where we need to focus our attention. What is happening with the consumer? I think the UK story, is really interesting as well. I think what's next just told us this morning is really worth paying attention to. The consumer feels like it's holding up. That's why I asked the question to Dan about what is happening with the housing market. How is the consumer feeling in the UK right now? Housing market's recovering. Next is telling us positive things. That is a huge support for the UK economy right now, but it also maybe marginally just keeps that service side inflation quite strong. Are people going, if they're spending in Next, does that mean they're going out and eating out more? Are they going to the pub more often? Does that support that side of the market where the labour market is very tight, where it's difficult to get staff, where wages are still rising relatively aggressively?
Another couple of themes to keep an eye on today then. The auto sector, we talked about that. There's a lot of toing and froing of different voices between China and Europe right now to try and settle this question of how high those tariffs are going to be. We've seen the strains on the domestic European automakers overnight, haven't we, with that really dreadful sales report and the drop back in EV sales. So we'll keep an eye on that. And from a geopolitics perspective, Anthony Blinken in the region, talking to a lot of foreign ministers.
The big question I have today is US equities sold off into the close yesterday. We've then got this pop this morning in futures, which has come out of Asia. Europe has responded to it. I'm looking at the numbers now. They're beginning to fade a little bit right now, but we're still elevated. We're still up by, let's call it 0.75%. Does that momentum continue into the US Open, or is the Asia story a head fake? And actually, the US close is actually where the heads of US traders are really right now.
Yeah, because the US picture was a lot more muddled. Asia and Europe maybe not overthinking it and just saying, you know, we've got 50 basis points, let's buy this. And to your point, Asia pushed the US futures picture higher. In Europe, yes, it faded a bit, but doesn't seem to be questioning that too much. So we'll see how that develops through the day. We will know by tomorrow. That is it for the opening trade today. European stocks then on the rise this morning, up by 0.8% post that big rate cut from the Fed. The Pulse is next. This is Bloomberg.